Today we are going to start MCQs from capital budgeting. Capital budgeting is also an important topic for section B, and examiner can ask a question for 10 marks from the capital budgeting. Or it is possible that he will ask question in section A as well. Capital budgeting focuses on what? Capital budgeting focuses on the concept of net present value, where we use what? Where we use present value table and as well as annuity tables. Details of an investment project are as follows. Cost of asset at the start of the project. Start always means year zero. Start means today. $80,000. Annual cash inflow $25,000. Cost of capital is 5% and life of the project is 8 years. Now the annual cash flows are constant throughout the 8 years. When your cash flows are constant throughout the 8 years, then you are not required to calculate the present value of cash flow for each year separately. You can calculate annuity value of cash flows is equal to your cash flow per year is 25,000. Then you will move on to annuity table. You will look at annuity factor 5% for 8 years. So for 5% and 8 years, you have a factor of 6.463. So you can multiply 6.463 to calculate the annuity value. So what would be our annuity value? 25,000 into 6.463. It is 161,575. Next step is to calculate net present value. It is equal to annuity value of cash flows minus initial investment. So we have NPV of 81,575 positive. So C is the right answer. This is the first question. Any question? Okay. Then we have the next one. A company is planning to open a new store in a new geographical location. An initial site evaluation has taken place at a cost of $5,000 and a store location has been found. New store can be rented for 95,500 per annum. It will require refurbishment cost at 320,000. Which of the following costs are relevant to NPV? An initial site evaluation has taken place at a cost of. Site evaluation means sunk cost. It is the cost which is incurred on feasibility study. If it is incurred on research and development, it is incurred on like drawing and designing, all the consultancy fees, it is an irrelevant cost, sunk cost. So 5,000 is not treated as a relevant cost. 9,500 is cash outflow. It will arise if we will make investment decision. So that's why it is a relevant cash flow, and refurbishment is a relevant cash outflow, or we can call it initial investment. So option number 2 and option number 3 are the relevant costs. C is the correct answer, that these two costs are the relevant cost. Understood? Next, B company is deciding whether to launch a new product. The initial outlay and the forecast possible and annual cash inflow are shown below. Year 0, 60,000. Year 0 means year of investment. Today. Then we have year 1, 2, 3. It is cash inflow. Cost of capital is 8%. Assume that cash inflow are received at the end of each year and the cash inflow for the each year are independent. What is the NPV for the product? Your cost of capital is 8%. So we will calculate present value at 8%. For year 0, we have a present value factor of 1. Then at 8%, we will look at present value factor. For year 1, we have, sorry, it is the annuity table. Present value table is this one. At 8%, we have 0.926 for year 1, 0.857 for year 2, and 0.794 for year 3. So 0.926, 0.857, and 0.794. Once again, we will confirm our present value factors. Yes, we use the correct one. Now you will multiply. For year 0, your answer will remain same, negative 60,000. For year 1, 23,350 multiplied with 0.926, it is 21,622. Then 29,100 multiplied with 0.857, 24,939. Then 27,800 into 0.794, 22,073. So you will add all the present values and less your initial investment. So your net present value is 8,634. So 8634 is the right answer. Any question? Okay. Now we will move on to the next question. An education authority is considering the implementation of a CCTV security system in one of its schools. Details of the proposed projects are as follows. Life of the project is 5 years. Initial cost is 75,000. These are annual savings. Annual savings means cash inflow. So the cash inflow is 2,500. Currently you have NPV at 15%, which is positive NPV. What is the IRR of this project? To calculate IRR, we need two present values or two net present values and cost of capital. IRR is equal to lower discount rate plus highest NPV divided by highest NPV minus lowest NPV into difference between high and low discount rate. Okay. If NPV is positive at a given discount rate, then we will calculate another net present value at a higher discount rate. Now we have positive NPV at 15%. So that's why we will calculate NPV at 20%. Our cash flows are constant 2,500 per year, sorry, 25,000 per year. So that's why we can use annuity value. So first of all, we will calculate annuity value of cash flows is equal to $25,000 multiplied with years are 5 and now our discount factor is 20%. So we will choose annuity factor at 20% for 5 years. 20% and for 5 years 2.991. So we will multiply it with 2.991. 25,000 into 2.991. 74,775 minus initial investment of 75,000 minus 75,000. So I have negative NPV of 225,000. One of the students asked a question, why did I choose 20% rather than 22%? I can choose 22%, but in my provided table, I don't have annuity factor or present value factor for 22%. Then I need to calculate my annuity factor for 22% with this formula. So I don't need to do this. I have 20% table. I will prefer to use my annuity factor and present value factor for the 20% rather to choose 22%. In fact, I need to do what? I need to pick a cost of capital which must be greater than 15% to calculate the another net present value. So I think 5% is a reasonable difference, and at 20% ideally I have negative NPV, so I can calculate my IRR easily. Clear? IRR is equal to lower discount rate 15. There is no need to use the percentage sign, plus highest NPV 8800 positive divided by highest NPV 8800. In the original formula we have minus and here we have negative NPV. So minus minus plus into difference between high and low discount rate. So now you can calculate first of all solve the brackets and then calculate. Your IRR is basically exactly 19.87% or 875%, or we can say 19.88%. But 19.88% is not provided. That's why nearest percentage 20% will be treated as internal rate of return. Clear? Any question? Okay. Next one is the following measure have calculated used to appraise a proposed project. IRR is 12%, cost of capital return on capital employed is 16%, cost of capital is 10%. IRR must be greater than the cost of capital, and here it is. It means what? It means project is profitable. If your IRR is greater than cost of capital. Project payback period is 4 years. There is no standard of project payback period is 4 years. It varies from project to project. The following statements is correct. The payback is 5 years to the project should go ahead. Not necessary. Maybe the payback period of any project is 15 years. It all depends upon the investment decisions. IRR is lower than the required return on capital employed, so the project should not go ahead. This is not a valid reason. IRR is greater than the cost of capital, so the project should go ahead. Yes, because project looks profitable. IRR is positive, so the project should go ahead. IRR is always positive. IRR does not presented in negative. There is no negative sign for IRR. So option C is the right answer. Next one is CC company is considering an investment of 300,000 which will earn a contribution of 40,000 each year for 10 years at today's price. Today's means year zero. The company's cost of capital is 11% per year. So initial investment is 300,000. Company will contribution for at each year for 10 years at today's price. At today's price means if we are provided with any inflation percentage, then we should adjust the inflation. But in S2 exam, examiner is not going to ask for the inflation adjustment. So that's why we will simply calculate annuity value at 11% is equal to annual cash flows are 40,000 into annuity factor at 11% for 10 years. So 11% and 10 years is 5.889. So you can multiply 5.889 with 40,000. It is 235,560 minus initial investment 300,000. So we have NPV of 64,440 negative. A is the right answer. Any question? Now examiner always try to confuse the students. Suppose one of the students is confused while solving this question in the exam, or student is unable to understand the difference between NPV and simple PV, means net present value or present value. And he calculates the annuity value and he found the figure and he or she says that D is the right answer. Figure is available among given options, which can give you an incorrect result. So you have what? You have incorrect option. Suppose in the exam, a few students are using calculator. After calculating annuity value, you write 300,000 on the calculator, and rather than showing negative sign with 300,000, you are simply writing $300,000 minus 235,560. Your answer will be 64,440 but positive, and you will say yes, I am correct. In fact, you are incorrect. So this is another mistake, but you found the figure. Another mistake, what could be? Suppose someone calculated annuity value, but he or she is not properly prepared with the topic, by chance calculated present annuity value. Now does not know the meaning of NPV. Read 10 years over here, hitting trial and error, divided by 10, and the figure is 23,556. Suppose he thinks that, yes, this one is the correct answer, but the correct answer is A. So please read questions carefully, solve carefully, use science quite carefully, because your slight mistake can lead you to an incorrect answer even if you are aware about the concept. Sandwich Queen is looking to expand its restaurant facilities to increase its seating capacity a further 40%. It is basically the concept of expansion. We are expanding our business operations. Food sales, drink sales, food cost, drink cost, staff cost, other cost, cash flows. Sales and variable cost will increase in line with, in line means 40%. With the seating capacity increase, the other costs are 40% fixed. It means out of this, 60% is variable and 60% variable 12 will rise by 40%. An extra employee will be required to serve the extra capacity. There are currently 4 employees on equal wages. So it means what? It means we are paying 40,000 to 4 employees. So 10,000 per employee is paid. So the additional wages will be 10,000. What is the relevant annual net cash flow to the nearest thousand of the proposed expansion? Only asking for the expansion. So that's why you will calculate incremental cash inflow of 40% from the sales, which is 370 into zero point 0.4, it is 148. Your food cost will rise by 40%. Your drink cost will rise by 40% in line with the seating capacity. So you can calculate 40% of 145, but it is a cash outflow. You can calculate 40% of drink cost. It is a cash outflow. There will be hiring of one extra employee, 10, and other variable cost will also rise by 40%, because variable cost is the cost which varies with activity level. So it is 4.8. Now you can calculate incremental cash flow by deducting all the costs from the additional revenue. 44.4. It is the incremental cash flow, relevant annual net cash flow. There is no use of any present value factors or annuity factors. Clear? Any question? Okay. Next one is, JAG company is about to invest $400,000 in machinery and the other capital equipment for a new product venture. Cash flow for the first 3 years are estimated as follows. JAG company requires 17% return for the project of this type. What is NPV of this venture? So the investment is 400,000. We have three cash inflows at 17%. Present value at 17%. We will look at present value factors. At 17% for year 1, we have 0.855, then 731 and 0.624. 855 for year 1, 731 for year 2, and 624 for year 3. Once again, we will check either we are correct or not. Yes, we are correct at 17%. Now you will multiply your cash flows with the present value factors. Here you have 179.55. Then you have 175.44. And then you have 199.68. Your initial investment is 400,000. Figures are shown in 100,000. So we will add up these values. We have a sum of 554.67 and we can calculate 400,000. 154.67. So positive NPV. Any question? But once again, someone calculates this value. After calculation of this value, he writes on the calculator 400,000 minus 554. So you will get the answer of what? You will get the answer in negative. Okay. A company has identified the NPV of the project is 17,706 when using 10% discount rate. So one NPV at 10% is positive and 4317 when using a discount rate of 15%. Calculate IRR percentage is equal to lower discount rate 10 plus highest NPV 17,706 divided by highest NPV 17,706 minus plus 4317 into difference between high and low discount rate. So now you can calculate your IRR. First of all, solve the brackets. Your IRR is 19%, right? Any question? Okay. Then a company is considering an investment of $400,000 in a new machinery. Machinery is expected to yield incremental profits over the next 5 years. Therefore, no incremental profit are expected. Thereafter, no incremental profits are expected, and the machinery will be sold. It is company policy to depreciate machinery on a straight line basis over the life of the asset. The machinery is expected to have a value of $50,000 at the end of the year. What is the payback period of the investment in the machinery? To calculate payback period, we need cash flows, but we are provided with the profit. So what will we do? We will add back depreciation to calculate the cash flow. Now depreciation is not provided in the question, so we will calculate depreciation per year is equal to $400,000 minus scrap value divided by useful life. So 70,000 per year is the depreciation. So you will add 70,000 in each year as depreciation. In year 5, you will also add scrap value because it's a cash inflow of 50,000. So add back 70,000 each year. 175 plus 70,000, I think it will become 245,000. Then 225 plus 70, 275,000. 340 plus 70, 410,000. 165 plus 70, I think it's 235,000. 125 plus 70, 195,000, and scrap value of 50,000. So now you can calculate your payback period. Next column is cumulative cash flow. In year 0, we made investment of $400,000. So we will start with the negative 400,000. In year 1, we have recovered 245,000 from 400,000. So the balance recoverable amount is 155,000. Then we have 275,000. So we are in positive with 120,000. So we have recovered what? We have recovered our investment in the second year. Means after 1 year, but before the end of second year. Now what would be the payback period? Definitely not option A. But what B, C or D? We will calculate payback period is equal to negative years. Negative year is only year 1, where we have a cumulative cash flow in year 1. negative cash flow. We will not count year 0. So negative year 1 plus last negative cumulative cash flow, which is 155,000, divided by next positive net cash flow, it is 275,000. So now you can calculate payback period. Formula is same which you are using from your study text or from anything else, like using lectures. There could be a change of words only. So what is the right answer? I think this one is the right answer. Did you calculate the value? So it looks me that it is the right answer. But let me check once again. Then what is an interest rate that includes the compounding known as nominal interest? Nominal interest is usually cost of capital, which we use to calculate the present value or net present value. It is the one which includes depreciation, inflation, sorry. It is the one which includes inflation. I can write the formula here. Nominal interest is equal to 1 plus general inflation into 1 plus real inflation. Simple interest means investment of $10,000 is made by you. Annual interest percentage is 5%. So every year you will earn what? You will earn 5% of 10,000, which is I think 500. Compound interest means you invested $10,000 and you will withdraw after 5 years. So 1 plus interest rate raised to power number of years minus 1. It means 1.05 raised to power 5 years minus 1. 1.05 raised to power 5 years minus 1. So in total in 5 years, you will multiply 27.62% after multiplication of 100. It means in total on 10,000 you will earn 27.62% interest. Here you will earn 500 per year. So in 5 years, 5% into 5 years means in the simple interest you will earn 25%. But in the compound you will effectively earn 27.62%. This interest rate, compound interest rate, also called effective interest rate. So I can use this effective interest rate for the compound as well. But alternatively, suppose you are provided with the data that you earn 28% interest in 5 years, and now data says that calculate per year interest. What will you do? You will use the same formula with slight change. 1.28, which means 1 plus rate of interest like this, raised to power 1 divided by n. N is number of years, but this time divided by 1, 1 divided by n, because you are performing reverse calculation. You are converting total interest from year 5 into year 1 interest. So that's why you will convert it by using what? By using the reverse concept. So what can we do? We can calculate the annual interest rate 1.28 raised to power 1 divided by 5, and then you can calculate effective interest. Next one is, which of the following statements about IRR method are true? So compounding known as effective interest, not the compound interest, compounding known as effective interest. Which of the following statement about IRR method are true? IRR considers the time value of money. Time value of money means present value of cash flows. This statement is correct. If IRR exceeds the company's cost of capital, the NPV at the company's cost of capital should be positive. In fact, it will be positive. This is also correct. It is possible for the one investment to have two IRR, yet there is a problem which is called IRR problem or multiple IRR problem. That's why these are correct. But in your syllabus in F2, examiner is not discussing multiple IRR problems. Any question? Okay, then now what is the effective annual interest rate of 2.1% compounded every 3 months? So 1.021 annual interest rate compounded every 3 months means in 1 year there will be 4 times 3 months time period will arise. So raised to power 4 minus 1, 1.021 raised to power 4 minus 1, and then you can multiply this answer with 100. So your answer is 8.67%. C is the right answer. Next one is, a bank offers different bank accounts with different interest rate. Bank 1 10% per year, interest calculated quarterly. 12% per year, interest calculated per month. Now it is on per month basis and this one is per quarter. What is the highest effective annual interest rate? First two interest rates are already given on per year basis, so that's why we will do nothing with it. Next one is 1.012 raised to power 12 months minus 1. 021 raised to power 12 minus 1. It is 28.32%. Then 1.03 raised to power 4 minus 1. 1.03 raised to power 4 minus 1. 12.55%. I think I should recheck this value. I think it is not correct. 1.012 raised to power 12 minus 1. Yes, the correct answer is 15.39%. So first one is offering 10%, 12%. This one is, third one is offering the highest per annum interest rate. So these are the MCQs of the capital budgeting from the section A. Any question?